Now to the retail side of things, breaking out this year, but it's in a number of e-commerce names that are really leading the pack in this particular trade. Check out some of the top performers this year in the popular Spider Retail ETF, the ticker XRT, Carvana, Wayfair, Stitch Fix, all up more than 50% or more in 2019. And then there's the behemoth, Amazon, up around 30%. But it's not so much of a behemoth in this ETF. So are these one-click wonders, or so to speak, the other ones, the best bet in this particular space? Christian, you run the IBUY ETF, focused on global online retailers. It is on the smaller side, but it's up about 30% or so this year. Tell us about that, and tell us about why it's different, that and the XRT, versus other indices, tracking instruments in consumer discretionary and retail, Christian.
Yeah, sure. So IBUY is the first and largest ETF focused exclusively on online retail stocks around the globe. There's actually a revenue test to be a stock included in the ETF. You have to have 70% or more of your revenue from online or virtual sales, or the Amazon rule, you have to have $100 billion or more of revenue from online sales. So it's a very pure play for online retail stocks around the world. So you see all these winners so far this year are top holdings in the online retail ETF, unlike XRT, the broad-based S&P retail ETF that has bricks and mortar as well as some clicks. This is exclusively focused in this fast-growing area of the market. We just saw the U.S. retail sales report last month in March. Online sales grew 11.6% year over year. Department store sales were down 3.6% year over year. Clicks are winning over bricks. It's a trend. IBUY is the #1 performing consumer cyclical ETF over the last 3 years and has generated a return over 100% during that time. The traditional retail space has languished, only up about several percent during that exact same time period over the last 3+ years. So we think online retail is the theme to invest in. It's a global trend. We think brick and mortar might be a trade in some cases. There's definitely some sentiment that has popped in some cases, but also dropped majority of the time over the last 3 years. So we think that's a trade versus an investment for the online retail space.
All right, so Tim, the reason why I wanted to highlight this is because in the intro I mentioned that massive run in Amazon shares. Yeah. But Amazon does not play all that much, or on a relative basis that much, in the XRT or the IBUY. Take us through that reasoning why, the equal weighted versus the market cap weighted, and is there a trend that you see developing with regard to Amazon versus everybody else out there?
Well, I would maybe even prefer to answer it. So look, like Apple in the XLK, there are ETFs that choose, and Christian and Amplify's ETF in terms of the IBUY has gone after those players that really are exposed to purely online retail. The problem with investing in an XRT, or maybe the benefit of an XRT, is not only is the equal weight does not allow the manager, it's an index, let's face it. But as a guy that also historically has run a long-short equity portfolio, a lot of people use the XRT as some type of a hedge or a measure of cyclicality in the global economy. Look, it's underperformed the S&P by about 500 basis points year to date. Why is that? Not because I think the composite of those companies are, yes, they may be a little bit more bricks and mortar over clicks, but I think a lot of this is a call on where we believe the economy is. And let's face it, despite the fact that the market's having a great run here and we're all-time highs, that's more a function of people actually fearing, I think, this tick higher. So know what you own with the XRT. This tends to be a high correlation to growth. As an EM guy, historically, I would short the XRT against it because it's very highly correlated with emerging markets.
So Christian, the equal weighted versus market cap weighted approach, we mentioned this a number of times in the world of ETFs. Do you see anything on your side that would suggest it is some of these smaller pure play online retailers that will really be the outperformers, or is just Amazon the way to go because it is the 800-pound gorilla in the industry?
Yeah, it's a great question, because we've seen even this year that Amazon isn't even a top 10 performer in the online retail space. It hasn't outperformed companies like Chegg or Etsy or Wayfair. Amazon isn't always the #1 performer. Why? Because it has a really diversified business, whether it's AWS Cloud or some of the spending they're doing to build out infrastructure for deliveries. It's a unique stock, and it certainly has had an unbelievable return, but it also has a lot of risks and volatility associated with it that aren't specific to online retail. So we think taking an approach to equal weight this online retail space allows you to have exposure to Amazon, but not to be overly weighted, and discover companies like Carvana, which is a top holding in iBuy that many investors aren't that familiar with, that's gained over 90% over the last year. So discovering new online retail companies is what iBuy is all about, and it's been able to deliver significant alpha both against the traditional brick and mortar, but even this year against a company like Amazon.
All right, Christian Magoon, thank you so much. We're going to leave it there for that discussion on retail as well as what's happening with financials. Thanks so much for joining us here today.